Okay, so first of all, thank you for attending the webinar. The idea today is to present the passive investing and how it can help you on your own investments. Okay. Uh, just before that, let me introduce myself. I'm Arthur. Currently, I'm a professor, and also I have a career in IT and business. And since 2016, I started investing here in New Zealand as well as in Brazil, where I'm coming from. Feel free to ask questions during my presentation. I don't mind. The important is that you understand the concepts, and if you have something to add or to ask, please just go for that. So first of all, I would say, why invest? Probably you want to get rich working for others or even for yourself every day from 9 to 6. Probably you need to have people, you need to have companies working for you so you can escalate your time. We know we have limited time. We cannot work more than maybe 12 hours per day. So, but if we have people and other companies, that will be much better. So when you become an investor, you become owner of profitable companies, and then you have other people and companies working for you. The second main reason, probably you want to have free time in the future. So to ensure, let's say, a decent retirement, you need to put your money to work for you and wait the time, the compound interest, to act on it. Okay, so that I would say are the two reasons why someone should invest. But what should we have before start investing? So I would say two things as well. So first of all, do not have liabilities, because let's say you are financing your house or your car. Makes no sense to you to start investing if, for example, your returns are lower than the interest that you're paying in your finance to pay your house loan or mortgage. So I would say try to eliminate or significantly reduce your liabilities before investing. The second aspect is you need to have an emergency reserve. Let's say, what if you got fired, or you have an accident, or someone in your family got sick? You need to have money quite available, quite fast to cope with that emergency. So it is recommended that you have at least 3 to 6 months of your monthly costs as a reserve. Okay. The other aspect before investing, you need to identify what would be your financial goals. For example, maybe you have a goal to preserve your capital. Maybe you have a good amount so far. So how can I preserve that amount? So maybe you can go for a very conservative investment just to preserve your capital. Another example would be, maybe you want to protect your capital against inflation that is quite high these days, or maybe against the devaluation of the New Zealand currency. So that might be another example of long-term financial goals that you have. A third one is this one. Maybe you want to have passive income. What if you can get money out of your investments every month to help you on the monthly expenses that you have? That might be a goal, and there will be investments to help on that. And finally, the last example here is, maybe you want to capitalize, you want to monetize your capital. So Probably you want to invest in a way that will bring a good return per year. Maybe we're talking about something from 8 to 12% on average per year. So the idea is that the investor needs to set up some financial goals, especially for the long term. Also, I would say as an investor, you need to know what is your investor profile, okay? I hope you guys are able to see the screen. So what are the investor profiles that we have? Maybe you are very conservative, the one who cannot see your balance, your portfolio balance lower than the amount that you invested. So if, let's say, if you put $100,000, you will not live well if you find like that is now $98,000 or $95,000 in your investment balance. So that will be the conservative person or investor, the one that wants to, even if there is small returns, but you don't see drop downs. The second profile, normally we call as moderate, is the one that they are okay to have some exposure to risk, and they are okay if there are some drop downs, but they are not strong. There are just slight declines in the amount that they invested. So that will be the moderate, not so conservative, but in the other side, not so aggressive. And finally, the third one, that is the aggressive profile, is the investor who is okay to face even major drop downs in the account if they see that there are opportunities, there are potentially higher returns, okay? So this profile is more exposed to risk, the appetite for risk is higher, okay? So as an investor, you should to identify yourself which one you are, and maybe you can take the, remember the crash in the market 2 years ago because of COVID. So depending on your reaction to that, it might say, oh, maybe you are not so aggressive as you thought you were, okay? Good. So those are the things that you need to have before start investing. Now let's go back to see why the passive investing, okay? So if you, there are basically two main approaches, what we call active investing and passive. Active is the one that you try to beat the market. So you think you have skills enough to identify what companies, what investments would perform the best in the coming weeks or months or years. So you go there and buy those one. And maybe if that company got a very high return in 2 weeks, you sell that and then you try to buy something that is cheaper. And when it goes up, you sell. So you are what we call timing the market. Okay, you try to figure out what are the dips and what are the peaks, and then you trade in an active way. Although the opposite is the passive investor, the one that he or she is okay if the investments that he or she has follow the market. It's in line, aligned with the market. Let's say if I have S&P 500 that performed 5% last year, the passive investor would be okay with that 5% because is the market average, okay? And then the point is, there are many, many studies saying that in the long run, let's say 5, 10, or even more years, 80% of investors would lose to the average market, okay? So why would you believe that you are smarter than 80% of the investor and you would beat the market? That is quite unlikely. Let me show you some figures about the performance of active managers and by consequence, the active investors too. So this page, I hope you are able to see, has quite surprising statistics, I would say, regarding the performance of funds. Let's say in New Zealand we have many, and let's say we would compare the performance of those funds with the index that we have here, that is NZX 50, with 50 companies, okay, listed in the NZX, our stock exchange. So this report covers the results from 2021, and it shows how is the performance in that year, last year, in the last 3 years, 5 years, and 10 years, okay? So we have some countries, let's say Brazil, where I'm coming from. In the last 10 years, 86% of the funds performed the index there in Brazil. 86%. And that's not so different if you take only the last 5 years. It's about 78%. And if you see other countries, like in the US, in the last 10 years, 83% of the funds underperform the index over there, that is the S&P 500. If you take the last 5 years, it will be 74%. So the figures are there. It's very difficult to beat the market in the long run, okay? And we have similar figures for other regions and countries. In Europe, almost 85% underperforming the local index there in the last 10 years. In Canada, again, 83%. Even in Australia, almost 80% of the funds. We don't have specific figures for New Zealand, but that thing goes on and on, like in Japan, in Mexico, South Africa, and other countries, okay? So that's the idea of the passive investing. Just be okay with the market performance, because on average, you would be better than 80% of the investors who are trying to beat the market. Good. The second main reason why you would consider the passive investing is the time that you would spend to timing the market, you know? So investing is not supposed to be funny or something that you go because you like it. Investing shouldn't be as boring as watching the grass to grow. So the idea is, don't waste your time trying to find the next big company, like the next Tesla, by reading reports or balance sheets. Try to figure out what would be the next company that will explode. Do the opposite. Dedicate your time, your hours, to your current source of income, or maybe to develop new sources of income. And then with your savings, you put the money to work and the compound interest to act on that. Okay, so that those are the two reasons why you should go for the passive investing strategy. Although I would say a little disclaimer here, I'm not a financial advisor. I'm kind of financial educator. I want to help people to know about those things, and they should, of course, evaluate the profile that they have, the goals that they have, what would be the best selection of assets. So do not take anything here as actual investment recommendations. Okay, try to get these as understanding the concepts and how would you create your own portfolio. Okay. Anyway, so moving on here, let me show you with more details what is that passive investing strategy. Good. So there are basically 3 steps to you to implement that. We will discuss that during the webinar, but just for you to have the overall picture. So step 1, you would define your investment goals. Remember the examples that I showed you guys. For example, capitalize your money and trying to get, let's say, 10% per year. And then you would build a portfolio with assets that have that capacity, probably based on statistics and historical performance, to achieve that 10% average return per year. Okay, but also in a way that your portfolio is aligned with your investor profile. That might be conservative, that might be aggressive. Okay, probably as a conservative, you will not aim of getting 10% per year. Maybe you would aim to get 2% just to cope with inflation, historical inflation, at least. So that would be step 1, define your goals and build the portfolio. Step 2 of being passive investor would be contribute periodically to your portfolio. Okay, because if you know the future value formula, and we can talk about that, the aspect that counts the most is the time, along with the regular contributions, but I will go back to that. So the second step here is make sure that you are periodically contributing more and more to your portfolio and do some rebalancing. I will explain later on what rebalancing is, but sometimes you need to look at your portfolio and say, oh, what should I buy? And sometimes, what should I sell? Okay, to optimize even more your performance. The third step would be time and opportunities. So do not panic when there is a crisis or when there is negative news. Maybe just forget about them. Do not listen to the news. Do not listen to political rumors or scandals. Just keep your approach, okay? And take advantage of some opportunities, take advantage of some market conditions or the market cycles that we have. All of us know that the markets are down since the 1st of January, and maybe that might be an opportunity. I'm not saying that you should try to time the market. I'm maybe just saying that you can, if you have a chance, what if you can invest more when the markets are down, okay? And finally, let the time to act on your capital, protecting and at the same time monetizing that in the long run, okay? Good. So what, when we are talking about a portfolio, that is your the set of investments that an investor has, what would be the characteristics of a passive portfolio? So some of them here. Of course, it should be based on your profile and your specific goals, it should be diversified, because you don't want to suffer when one specific asset class, like we have cryptocurrencies nowadays, that they are just crashing down. So in fact, you should have the opposite. You should have a diversified portfolio, diversified among different asset classes, like bonds or stocks or real estate or even cryptocurrencies. Okay, you should have something diversified among geographies. Do not put all your money in your home market, or we should have investments from different parts of the globe, like US, Europe, emerging markets, Australia, New Zealand. Okay, so that is the idea of diversification. What else? Normally, the passive portfolio would be made by ETFs. ETFs are, rather than buying one stock here and there are financial assets that they put a lot of shares in just one single investment. For example, we have the S&P 500. It comprises 500 companies from the US in a single investment, okay? And that is an ETF. It's like a fund. It is an index fund because it follows the S&P 500 no matter what. So if S&P 500 is going down, your fund will also go down in the same proportion. And the ETF is a fund. It's an index fund that is traded on the stock market. So you can go there and buy exactly at this time. Okay, so that is an ETF, and it provides you more. They are simpler. They have lower fees. They have less risk because you are buying 50 companies or 100 companies or sometimes 9,000 companies together. So what is the probability of all of them to go to zero, as we had some companies in the past that literally went zero, like Kodak or Nokia, you know? Good. So we passive investors are fans of the ETFs because of those characteristics. What else? Of course, we are looking at the long term, not the short term, not trying to time the market. As I said, your passive portfolio should receive, or it would be important. It will make all the difference if you can contribute regularly, maybe weekly, maybe monthly. Okay, and sometimes you can do the rebalancing, selling something to buy something that has not performed so well, but I will go back to that. And among other characteristics. Okay. Good. Let's see. I was about to show you guys why the time is so important. So if you ask me, is there a formula to get rich? I would say yes, but this formula will make you get rich slowly, not get rich fast, as people are trying to sell formulas all over the internet. So this is the future value formula. It's quite simple, despite of the components here, but it has just 3 components. What would be your final investment? What is your starting investment? And note that you can start with 0 if you don't have anything, okay? The contribution, how much you contribute every month, for example, your return rate, and the time. Okay, so note that the time is the only variable that is in the exponential here. So the longer your investment, the higher the return will be. Okay, but of course, the higher your contribution, the higher your future value will be. The higher your starting balance, the higher your future value will be. Okay, so that is the formula, and the idea is quite basic. If you are contributing quite frequently, and if you manage to get a good rate of return on average, and if you stay invested for the long run, your future value will be maximized. Okay, so we can do some calculations here. Okay, let me go for this calculator website. I hope you are able to see. That is the compound interest calculator. That is exactly the future value idea. Let's say if you start with $1,000, okay, and let's say that you manage to get 1% per month. I know it's not so easy, but it's feasible, I would say. If you take S&P 500, the index from the Wall Street in the US, on average, the return was 12%, from 12 to 13% on average per year. So 1% is feasible if you select a good investment, and probably if you take for some time, okay? Hold that for some time. So let's say 1% per month, and let's say that you would invest for 20 years, okay? 20 years. And now let's say that you will contribute 1,000, or let's do the calculation without any contribution. Just let those 1,000 by 1% per month during 20 years. Let's see how much you would get. So if you do that, by the end of the 10 years period, you would get almost 11,000. That's not that much, but is almost 12 times more, 11 times more than your initial balance, okay? But of course, you will not be rich. But now, let's see the difference when you put 1,000 more each month, okay? Without dealing with inflation in this little example. So in addition to that 1,000 start balance, let's go for 1,000 every month. So the figures change a lot. Now, with that approach, by the end of 20 years, you would become a millionaire. Okay. So note the difference. Because of that 1,000 every single month, by the end of 20 years, with the same rate of return, 1% on average per month, you would become a millionaire. And note that you just put your own money, 240,000. Okay, it's quite less than the 1 million that you get by the end. So this entire amount, 760,000, is what you get by interest, by the return of your investment. Okay, so that would be my formula to become a millionaire, but it would take me 20 years. And the secret is to hold for those 20 years, and the 1,000 monthly contribution. Okay, good. So now that you know the formula and now that you know how to become a millionaire in 20 years time, what you can do to try to maximize the results. So you can, working in the contribution side, you can increase the amount of your periodic contribution. You can increase the frequency. Maybe what if you start putting something every week rather than every month? And the other option is try to ensure that you will not suffer ups and downs. Remember, if you have a chance to get that 1% flat, 1%, that would be perfect without ups and downs, okay? Because maybe you don't want to get like 10% in the first year, and then it drops 12% in the second year, and then it goes up 22% in the third year, but in the fourth year it goes down 30-something percent. That's not a smooth ride. That is a bumpy one. It's a bumpy road. Okay. Good. What else you can do? Work on the variable of time. So invest for as long as possible, maybe your lifetime, or until you realize that you get enough to retire. And I would say don't make unnecessary rebalancing. Try to avoid too many rotations, selling and buying, selling and buying. That's like the soup. Sorry, the soap. Every time you take the soap, it goes away, you know? So don't do that if your portfolio. And the third thing that you can do is work on the rates, the return rates. So maybe you can try to get a higher return rate for the level of risk that you want to have. Also, as I said, try to minimize the fees that you are paying. And the ETFs, remember I told you about the ETFs. The ETFs have normally a fee of, let's say, 0.3, 0.5% per year. It's quite low comparing to the funds that would charge you maybe 2% per year plus the performance fees. If they beat the index, they would charge, let's say, 20% on the proportion above the index that they benchmark the fund. Okay, good. And also try to avoid paying unnecessary or upfront taxes. Maybe if you sell, you will get you need to pay taxes. So that is not clever if you want to maximize your results. Good. Okay, going back, maybe what if we take a look in one example? What might be one portfolio here in New Zealand using the ETFs and other index funds that we have here? For example, I know that everyone should look at your own profile, your goals, and this example, I would say is quite aggressive because it only has equities. It does not have bonds, government bonds, what we call the fixed income. Fixed income is when you know beforehand what would be the return of that investment. Okay, like the term deposits that we have here in New Zealand. So you know that if you take that for 5 years, if you hold that for 5 years, they will pay 3% per year. Okay, that is not so high, but it's fixed. You know beforehand how much would you get if you remain for the entire period. So this example does not have fixed income, just what we call growth income. That is stocks in the market share or ETFs or even real estate funds. You don't know how much you would get because it varies depending on the market. Okay, but anyway, let me show this example. You might have with 4 ETFs only. Let's say you put 25% in the local market. You might buy a single ETF that buys 50 New Zealand listed companies like Air New Zealand or Auckland Airport or Tauranga Port or Fonterra and those ones. So with a single investment, you can have 50 companies under that ETF. Let's say someone might put 25% of the investment balance on that one. Another one would be 20% in the Australian markets. They have a similar index. The difference is that the index from Australia has 200 companies, okay? Like they have all the banks that we have here, ASB, ANZ, and other companies like the holders of Countdown, those companies are from BHP, that is all about oil and things like that. Okay, so the second ETF here buys 200 companies, so with a lower risk that buying individual ones in a single ETF. The third ETF here is 25% in the what we call developed markets. Let's say we have US, Japan, Europe, some countries in Asia, even Australia might be here as well. So you will get US in the higher proportion here, like maybe 70% of that ETF will be based on US companies like Google, Microsoft, Amazon, and many others. Some from Europe, some from Japan. Okay, that would be the developed market ETF. And then let's say that you want some risk in your portfolio, so you might consider buying the emerging markets ETF. So many companies, sometimes 2,000 companies from countries like China, Russia, not anymore, but Brazil, Mexico, South Korea, okay? And then the idea of this example portfolio is you buy 4 of them, probably when one go up, not necessarily the others will go up. Maybe New Zealand is okay, probably Australia is okay as well, but maybe developed market is not performing that good. But in the other hand, emerging market is performing good. So because of you have 4 and they are diversified, basically you are buying all the stocks in the globe. That tends to minimize your ups and downs, okay? Good. So that might be an example. But let me finally go back to the actual steps. So to see more details, the details of those 3 steps that we discussed. Some of them we explored so far. So first one, remember, identify your profile as investor. The second task would be defining your goals. And remember the examples that I expose it, preserving our capital, preserving against inflation, preserving against the devaluation of the currency. Also have a set of investment goals. And the third step, or the third task under step 1 would be, finally, you build your portfolio with asset classes that would form that passive, balanced, low cost, and diversified portfolio. Okay. Remember, my example was using the ETFs with very low cost from 4 regions in the planet: emerging markets, developed markets, a little bit of New Zealand, a little bit of Australia. Okay. So that would be that step: build your portfolio, take into consideration the profile and your objectives, and also diversified asset classes. Okay. Second step is stay invested. Okay. Do not try to time the market. Just stay there. Remember the periodic contribution. So that is the step 2.1. Put regular contribution, because you know that the greater your contribution, the greater will be your final balance, and the more frequent you contribute, the greater will be your final balance. And then that concept of rebalancing. Maybe you see the idea, because you will contribute, let's say, every month or every week, rather than selling what has performed the best, you might buy the assets that performed the lowest. Okay. So remember my example of 4 assets. Let's say that emerging markets did not perform it so well in the last month, and now it's time to you contribute. So I would buy more of that ETF from the emerging markets, because if I do that, I will buy low. I'm paying less for that ETF, rather than buying the one that performed the most, like maybe Australia did. So you can do the rebalancing by buying the assets that have the largest deviation from your desired initial allocation. Remember, maybe you start 25% in each one. Now you see you are about to invest some amount, and then you see that emerging markets represents 20% of your current portfolio. So I would put more in that rather than buying more from the other that has outperformed. Okay, so you can do a good rebalancing without selling assets and without paying fees and without get taxed on them. And finally, the third step, that is basically just wait. Do not panic when there is a crash in the market, as the one that we had during COVID in March 2020, or as we are facing now. Since 1st of January, the market has gone down. So maybe if you have a chance, you would buy more of those ETFs just to get better price. Okay, so and then wait. And as I said, maybe you should dedicate your hours to your current job rather than trying to follow the market, because you know that 80% of the investors who are trying to time in the market will underperform in the index. So just buy the entire market and leave, I would say. Good. So those are the steps in details. And now let me just show you guys my own portfolio and my approach. And again, this is not an investment recommendation. I try to educate people about this approach and maybe to share the things that are, I would say, working for me in the last 6 years. So this is my own portfolio here in New Zealand. I have something similar in Brazil. So remember that, for example, with 4 ETFs, I have quite that. I have currently it's about 16% in the emerging markets, almost 20% in the Australian market, 39% in the developed markets, such as US, Europe, Japan, UK, those developed countries, and the remaining 25% in New Zealand shares, the index. So here you can see exactly what ETF I've been using and the fees. So for example, this one, it charged me 0.30% per year to have that ETF. And then probably I would say, if I have a new contribution to do, probably I would go for this emerging market because I see that it has the lower proportion. So if I want to have 25% on each, now it's time to put more money in these emerging markets to try to rebalance without selling, for example, the developed market to buy the emerging market. So I would rebalance using new contributions. Good. Okay. So here is the performance of, is not up to date. And the reason is because the tool that I was using does not allow me to compare that anymore. But I would say, I know that from January 2022 up to today, the market's going down. So if you see the new one, it will go down this final segment here. But from this period, my current performance, my performance was around 12% per year. That is around 1% per month. That is my goal, by the way. And then the funny thing here is, this is using those 4 ETFs: US, developed markets, emerging markets, Australia, and New Zealand. But note that this blue line here is just one single ETF. That is the total world. So it's one single asset that buys more than 9,000 companies across the globe, including emerging markets. And note that if I had started with that single ETF, the total world ETF, I would be almost in the same position as I am, trying to buy those 4s and do the rebalancing every time I'm buying something. Okay, so maybe if I had the chance to start all over, I would just go for one, and that one would be the New Zealand X Smart Shares Total World, and this ETF buy an ETF from US that is the Vanguard Total World, that is quite a low fee. I think it's 0.03% per year, so almost nothing, and you are exposed to more than 9,000 companies across the globe. Okay. Similarly, I have my portfolio in Brazil. And in Brazil, I have not only ETFs with stocks or shares, I have real estate, I have fixed income like the government bonds. And note that in the last 5 years, the yellow one is my portfolio and the red one is the local index there. I'm beating the index just by a small margin currently, but maybe another option would be just buy that single ETF that tracks the local index there. Because as I said in the beginning, in 5 years or more, 80% of the investor would underperform the index. That is almost my case, but I'm still a little bit higher than the index in the last 5 years. Okay, so basically that is me, and now let's open for questions. If we have some.
Sure, that's been very informative. Thank you, Arthur. In terms of just sort of starting out, like you said, find a broker or something. Is there any advice around that?
Okay.
Recommendations or anything like that? Yeah.
Okay, I will share that again to show you the one that I'm using. Again, it's not a investment recommendation. So I'm using this one that is Invest Now. It's like I hope you can see the screen. So it's a platform here in New Zealand that you might buy many ETFs and funds. You cannot buy individual shares here. You cannot buy Air New Zealand alone or Fonterra or Google. You only buy ETFs. They don't charge you a monthly subscription or a fee every time you buy. They are just a platform that consolidates in a single account all the investments that you might have. And you can buy active funds like Milford or others, or you can buy the ETFs. For example, if you go to Smart Shares, that is the ETF issuer. It's one company from NZX, that is our stock exchange here. So if you go here using Invest Now, you can buy one of the 37 ETFs that they have. For example, remember that I mentioned the emerging markets. So you can buy this one, and you will only pay the fees that the ETF charges you. You are not paying commission to this platform. So I'm using that, quite happy with them because of the low cost and because it blocks me to think, oh, what if I buy single companies that I really don't want to do? Because, yeah, so if you, let's say, if you just as an exercise here, let's say that you go to the NZ website, and then you go to, let's say, our fund that follows the index, that is this one, okay, FNZ. So you can see here the historical performance of the index, our index comprising 50 companies. So if you take a look in the last 2 years, it went up. The highest was January 2021, and then it went sideways. It went up in the end of the year. Yeah, again, another peak here. But since then, it went down, okay? But now let's compare. Do you know, do you know 2 companies listed in the stock market here?
I suppose Air New Zealand is one of them. That's probably gone down.
Okay, Air New Zealand,
and
I think is there. We can confirm. I believe, yes. Do you have another one?
How about maybe, I don't know, is there some like utility company or something, electricity?
Okay,
I can't remember the name.
maybe contact.
Mercury, I don't know. Yeah, Contact,
Mercury.
yeah.
I think contact is CNN. Okay, assuming that those are the companies. See, what our webinar was all about is, so now we have the colors here. So the index is the, let's say, brown, okay? This one, in the last 2 years. The green is contact energy, and the blue is Air New Zealand. So note that the brown one, the index, is much more stable than the individual stocks. See, because Air New Zealand was high again, and it went low, and now it is at the lowest. Okay, if you can see here, it's negative in the last 2 years. If we take Contact, it's still positive in those 2 years, 20%. That's good, but it went up, very up here and lower here. But what if you just got the index? You would be 8%, 90% positive in the last 2 years without that ups and downs. Okay, so that is the idea. So see, if with just 2 stocks here, I would be better with the index rather than those 2 that. If I take the average of those 2, probably, because in one I have -9 and the other I have like almost 20. So if I got the average, I would be like 5% up in the last 2 years. But the index, without any study, I don't need to follow the news about Air New Zealand or Contact Energy, I would be 9%, you know? So that is the idea. And if you take the long run, the index would be quite safe, I would say. Okay, good.
Thank you.
Any other questions or comments or feedback, or was that helpful?
Yeah, definitely helpful.
Okay. Thanks so much. If you don't have a question, thanks for attending. Now you have my website, my contact. Feel free to ask me questions or just take a second look in the website. Thank you.
Thank you. All right. Catch you later.
Bye. Bye-bye.